If you buy life insurance, are you buying protection for the years your family depends on your paycheck? Or are you buying a lifelong financial product that also builds cash value? That is the real question behind term life versus whole life insurance. One policy is mostly temporary protection. The other bundles permanent protection with a savings-like account inside the policy. The mistake is comparing them as if one is simply cheap and the other is simply expensive. They are not just two prices for the same thing. They are two different structures with different trade-offs. So in this video, we are going to separate the insurance part from the savings part and look at what you are really paying for. Start with the basic problem life insurance is meant to solve. If someone depends on your income, your unpaid labor, your care, or your financial support, your death could create a money gap. Life insurance is a contract designed to fill that gap. You pay premiums. If you die while the policy is active, the insurer pays a death benefit to your beneficiaries. That part sounds simple, but the design of the policy changes everything. Term life insurance is like renting a safety net for a specific period of time. You might buy coverage for 10, 20, or 30 years. During that term, you pay premiums. If you die during that period, the policy pays the death benefit. If you outlive the term, the coverage usually ends unless you renew, convert, or buy new coverage. There is usually no cash value. You are not building an account that you can withdraw later. You are paying for risk protection during a defined window. That is why term life is often much cheaper than whole life for the same death benefit. The insurer is covering a temporary risk, and many people will outlive the term. Whole life insurance works differently. It is a type of permanent life insurance. It is designed to stay in force for your entire life as long as required premiums are paid and the policy does not lapse. It also builds cash value inside the policy. That cash value is one of the main reasons whole life premiums are much higher than term premiums. Part of the premium pays for insurance protection. Part helps build the policy's cash value. Part covers expenses, commissions, and the insurer's costs. So the first mental model is this. Term life is mostly pure insurance for a temporary need. Whole life is a bundled product. It combines insurance, long-term guarantees, and a cash value feature. Neither structure is automatically good or bad. The question is whether the bundle matches the problem you are trying to solve. Imagine a parent with young children, a mortgage, and 25 years until retirement. If that parent dies tomorrow, the family may need money to replace income, pay bills, cover childcare, and keep long-term plans from collapsing. But after the kids are grown, the mortgage is lower or paid off, and retirement savings are built up, the need for a large death benefit may shrink. That is the kind of situation term life was built for. The need is real, but it is not necessarily permanent. Now imagine someone who has a lifelong dependent, a complex estate planning need, or a strong desire to leave a guaranteed death benefit no matter when they die. That is a different problem. A temporary policy may not match a permanent need. This is why the first question is not, which policy is better? The first question is, how long does the financial risk last? If the risk is temporary, a temporary policy may fit. If the risk is lifelong, permanent coverage may be worth considering. Before we go deeper, if you like calm explanations of money decisions without hype or pressure, consider subscribing. The goal here is not to tell you what to buy. It is to make the trade-offs clear enough that you can ask better questions before you sign anything. Now let's talk about premiums. With term life, the premium is usually lower because the policy has a narrower job. It pays only if death happens during the term. There is no cash value being built for you. You can think of it like homeowners insurance or auto insurance. If your house does not burn down or your car is not totaled, you do not get your premiums back. That does not mean the insurance was a waste. It means the bad event did not happen. This is where a common phrase can mislead people. Some people say, term life is throwing money away if you outlive it. But that is not really how insurance works. You were not buying a refund. You were buying protection from a financial disaster during the years when that disaster would have hurt most. Whole life premiums are higher because the policy is trying to do more. It is designed to keep coverage for life, not just for a term. It also has cash value that can grow over time. The insurer must price the policy so it can support a death benefit even at older ages, when mortality risk is higher. In other words, whole life is not expensive only because it is inefficient or fancy. It is expensive because it is making different promises. But those promises come with trade-offs. The biggest trade-off is opportunity cost. Every dollar that goes into a whole life premium is a dollar that cannot go somewhere else. It cannot pay down high-interest debt. It cannot build an emergency fund. It cannot go into a retirement account. It cannot be invested in a low-cost portfolio outside the policy. That does not automatically make whole life wrong, but it means the comparison is not just term premium versus whole life premium. The comparison is whole life versus term life plus whatever you would realistically do with the difference. And the word realistically matters. There is a popular rule of thumb that says buy term and invest the difference. In theory, this can be powerful. You buy lower-cost term coverage, then invest the money you saved in premiums. Over decades, that outside investment account may become a major asset, but the strategy only works if you actually invest the difference. Keep investing it, and do not rate it every time life gets expensive. If the difference just disappears into lifestyle spending, then the comparison changes. Whole life can act like a forced savings mechanism for some people. The premium is due. The policy has rules. The cash value builds inside a contract. For someone who values discipline, guarantees, and permanent coverage, that structure may feel useful. But forced savings is still not the same thing as free money. You are paying for that structure through higher premiums, policy expenses, and reduced flexibility. Now let's unpack cash value, because this is where many misunderstandings happen. Cash value is not the same as the death benefit. The death benefit is what beneficiaries receive when the insured person dies, assuming the policy is active and the claim is valid. Cash value is a living benefit inside many permanent policies. It can sometimes be accessed while the insured person is alive, but access is not always simple. You may be able to borrow against the cash value, but a policy loan is not free money. Interest can accrue. If the loan is not managed, it can reduce the death benefit. In some cases, if the policy lapses with a loan outstanding, there can be tax consequences. You may be able to surrender the policy and receive the cash surrender value, but surrendering means giving up the policy. Early in the life of many policies, surrender value can be much lower than the total premiums paid because of fees, surrender charges, and the way cash value accumulates. This is one of the biggest risks with whole life. The product can make sense only if you can afford it for a long time. If the premium is so high that you cancel early, the outcome may be disappointing. So when someone shows you a whole life illustration, do not look only at the future values. Ask what happens if you stop paying in year 3, year 7, or year 12. Ask what values are guaranteed, what values are not guaranteed, and what assumptions the illustration is using. Also ask how the death benefit works if you borrow money from the policy. Many buyers do not realize that accessing cash value can affect what beneficiaries receive later. Another common misunderstanding is that whole life is just an investment. It is better to think of it as insurance with a cash value component. That distinction matters because an investment account and a life insurance policy are built for different jobs. An investment account is usually built for growth, liquidity, and flexibility, with market risk depending on what you own. A whole life policy is built around insurance guarantees, premium obligations, cash value rules, and a death benefit. It may have useful financial features, but it is not the same as buying an index fund, a bond, or a savings account. This brings us to the most important practical question: who actually needs life insurance? A person usually needs life insurance when their death would create a financial problem for someone else. That might be a spouse who relies on shared income. It might be children who need years of support. It might be aging parents. It might be a business partner. It might be someone who co-signed a loan. It might be a family that would struggle to pay final expenses. If no one depends on you financially, you may need little or no life insurance. That can change later. A new child, marriage, mortgage, business, or dependent can change the need. So before choosing term or whole life, ask 3 questions. First, who would be hurt financially if I died? Second, how much money would they need? Third, how long would they need that protection? Those questions often point toward the structure. If the answer is, my family needs a large amount of protection until the kids are grown and the mortgage is manageable, term life may be the simpler tool. If the answer is, I need coverage no matter when I die, and I can afford the premiums without sacrificing other basics, then permanent insurance may deserve a closer look. But affordability should not be treated casually. A policy that looks perfect on paper can fail if the premium does not fit real life. Life insurance competes with rent, food, debt payments, emergency savings, retirement contributions, medical bills, and everything else. Buying more complex coverage while ignoring basic financial stability can create pressure later. A useful test is this: if you bought the policy and then had a job loss, a medical bill, or a major repair, could you still keep it? If not, the policy may be too large, too expensive, or too inflexible. There is also a sales risk. Whole life is sometimes presented in a way that emphasizes the attractive parts, like permanent coverage, cash value, and tax features, while minimizing the trade-offs, like high premiums, slow early cash value growth, surrender risk, and opportunity cost. Term life can also be oversold. A very large term policy may be unnecessary if the actual financial need is smaller. A term that is too short may leave someone uncovered while the need still exists. A policy that cannot be converted may create problems if health changes later and new coverage becomes expensive or unavailable. So the best comparison is not emotional, it is mechanical. Term life asks, what death benefit do you need during the years when people rely on you? Whole life asks, do you need permanent coverage? And are you willing to pay higher premiums for lifelong insurance plus cash value features? The cleanest way to think about it is to separate the jobs. Job 1 is protection. If you die, who needs money? How much? And for how long? Job 2 is saving or investing. If you are paying extra for cash value, what are you giving up? And is the policy the best place for that money? Job 3 is flexibility. If your income changes, can you keep the policy, adjust it, or exit without major damage? When those jobs are mixed together, it becomes easy to buy something because it sounds sophisticated. When you separate them, the decision becomes clearer. Term life is not automatically better because it is cheaper. Whole life is not automatically better because it lasts forever and has cash value. Each one is a tool. The right tool depends on the risk you are trying to transfer, the length of that risk, and what else your money needs to do. So before buying, do not start with the product name. Start with the money gap. If I died, what bills, income, care, or obligations would disappear or remain? How long would that problem last? What is the simplest, most affordable way to protect against it? And if a policy includes cash value, what am I paying for that feature? What can go wrong? And what else could I do with the same money? That is what you are really buying. Not just term life or whole life. You are buying a set of promises, limits, costs, and trade-offs. If you have a question about life insurance, cash value, policy loans, or another money topic you want explained in plain English, leave it in the comments. Your question might be the next topic we break down.